the bank.
Hey Brett, how's it going this week?
Good, Ange. How are you?
Pretty good. Well, that means it's another episode of Money in the Bank, the personal finance podcast where we talk about all things related to personal finance and more. It's very fun.
Always a good time.
So we are trying something new. We mentioned in our a couple episodes ago that our audio has been pretty inconsistent because we're living in an apartment and all that jazz. So we are trying out a sound booth now, and hopefully that'll make our audio a little bit better. But we'll see, because we happen to come to the sound booth the same day that there's like this big open mic night and like a whole rock band outside the doors.
So if you can hear that in the background, we apologize, but the irony is not lost on us.
All right. So do you know what we're talking about this week?
I think HSAs was on the docket. All right.
So your trivia question, which one can it's like a 50-50 chance, right? So which one can you contribute more to, an HSA or an FSA? Annually.
I think the technical answer is FSA, because I don't know that there's a cap on that I'm aware of. I know HSA has a cap.
There is a cap.
Okay.
So HSA you can put more into.
Oh, well, of course, because I'm wrong. So.
Of course. All right, so let's jump in. This was actually a user-requested episode, which we love getting ideas from you guys. So very excited to do this because I realized, I have been using an HSA for years. We've been on a high-deductible plan, and we've mentioned it kind of throughout different episodes where we've talked about health insurance, but we've never taken a step back to be like, hey, this is exactly what an HSA is, and we've never really done the whole compare and contrast with an FSA.
Yeah, we don't really talk about FSA very much, right?
No. So, second part to your trivia question, do you know what HSA...
When did we start doing this?
Pop quiz, do you know what HSA and FSA stands for before we just confuse everyone with acronyms?
One is a health savings account.
Yes.
And one is a flexible spending account.
Yes.
Right?
That's great. And I think that explains a lot of the difference if you really think about it. The flexible spending is implying that you're spending, right?
That you need to use it.
And the health savings really
makes it long term.
Yeah, every time I hear savings, I think long term. So I think let's start with FSAs because I don't think I have as much to say about them.
Okay. They're pretty straightforward, right? Because they're, not many people use it, and that's for good reason, because you have to use everything by the end of the year, right?
Correct. Yeah, it is. Kind of correct. It is technically use it or lose it, but it is also very employer specific. So some employers will actually say, hey, you can have, 2 months into the following year to use up any money you have left over. And some say, you can roll over maybe a couple $100 or something. So the same way that I think of 529 plans are very state specific, FSAs from the research I did are very employer specific. And the other interesting thing I found out, which I didn't know, I guess, I thought you could have an FSA attached to kind of any health insurance policy, but you actually have to have health insurance through an employer to utilize an FSA. So if you're self-employed, you cannot use this option.
Okay, so there's some legal loopholes surrounding it also, or maybe somebody would consider it protections, but other people would consider disadvantages.
Yeah. So yeah, I thought that was really interesting. And then from what I found, and again, this might be different per employer, but you could contribute $26.50 per year to this account. And like Brett mentioned, it is use it or lose it. So basically the money that you put in here, you really want to put in if you know, okay, I'm going to have maybe a root canal, or I'm going to have certain medical expenses that I know I'm going to have this year, then you can put that money in. And the benefit is you don't pay taxes on this money. So you can pay for your medical expenses tax-free if you know they're coming. The catch here is you don't really want to put in money that you might not use. So if you're like, oh, well, maybe I'll, need this money.
Right. You're not going to put it in if you think you're going to get the flu this year, right? Because you might not use it and then it's gone. But you would definitely use it for, I think the primary use case most people actually go after this for is if you're definitely going to have a baby in that year, right? So if you're going to have a baby in July, you're definitely going to want to be pouring money into it in January up to when that happens, and that all of that money kind of gets used with the tax benefits applied for that purpose.
Yeah. So some people use it for that. I know some people, if they know they're going to buy glasses every year or something like that, they might pour money into it. And the other thing I wanted to mention really quick is if you are going to use an FSA or an HSA, and you're like, oh yeah, I'm going to have these medical expenses next year, please make sure you actually check with the qualified expenses, because they do vary a little bit between the two vehicles. So, in your example, you said having a baby, that should probably be covered. I think medical expenses like that are pretty broad. However, premiums are not. So you might say, okay, I'm going to upgrade my plan, to get a little bit better insurance for the year that I'm going to have a baby. And I'm going to put the difference that I need to pay in premiums in this, right?
Mm-hmm.
But you can't actually pay for premiums on a health insurance policy with either or plan. So you mean neither? Yeah, sorry.
Neither an HSA or an FSA can you pay premiums for with?
Correct, but there is an exception that we will talk about with HSAs later.
Okay.
So, so I guess the big thing here is an FSA, the money is use it or lose it, but you're going to have to check with your specific plan to see what the rules are, because they're all a little bit different, so I don't want to tell you anything wrong. And that, I guess that's basically it. FSAs are pretty cut and dry, right? So you put money in if you're going to have expenses, and it is what it is.
Okay.
So let's move on to the really exciting one. I mean, just so exciting. I don't know how people don't, when you hear HSA, it's just woo, right?
Yeah, wow. Don't get quiet down over here. It's almost like you're talking about compound interest.
So, HSAs are triple tax benefits, which is really exciting. So you can put in $3,500 a year if you are single or on a single plan, or $7,000 a year if you're on a family plan. But the exception with these is, for an FSA, let's say you're on an 80-20 health insurance plan. You can still set up an FSA if you know you're going to have certain medical expenses. With an HSA, you can only contribute if you have a high deductible plan. However, if you had a high deductible plan for 5 years and you put money into this HSA and then you get off of the high deductible plan and you start incurring some medical expenses, you can still use your HSA. You just can't put new money into it. Does that make sense?
Yeah, and a high deductible plan versus a PPO, is that what the other option is that usually the employers see?
PPO, HMO, I think. There's several different kinds out there.
Okay.
Yeah.
But it'd be called something like that versus the HDP or high deductible plans.
Yeah,
it's usually
HDHP.
Yeah.
And usually you'll see 90-10, 80-20, because those are the portions that you pay of co-insurance. So yes. So high deductible, they will make it very clear that you are signing up for a high deductible plan, and your deductible will be much higher. I don't want to give quotes here because, I've seen some where the high deductible is as low as $1,500, which I know I just said low and $1,500 in the same breath. But some high deductible plans can go all the way up to, I think I've seen one as high as $15,000, $20,000. So that's a big spread.
I was going to say, I know I've seen them at 10, so yeah, 15's a lot.
Yeah. So, anyways, HSAs are very exciting, and you can use this if you have a high deductible plan. Now, who do I recommend this for? I recommend this for most people who have fairly low medical expenses. So I have actually done the math, and for most people, most healthy people, I should say, in that cohort of healthy lives, if you get a low deductible plan, right? Let's say a 90-10, and you're paying these really high premiums, and at the end of 20 years, you have nothing to show for it. Where if you take the high deductible plan and you lock in the lower premiums, and then you take that difference in premiums that you would have paid, so let's say it's $100 difference to get the high deductible plan versus the low deductible plan, and you just save that $1,200 for 20 years, you're probably going to come out ahead, even with the higher deducticles that you have to pay.
Right. So on average, the normal person, right, or the average person, or the categorically kind of healthy person is not going to pay money over time to the doctor for what that's worth.
Correct.
Right? So then they'll make out ahead by basically paying for their own health care.
Right.
But then also having like the catastrophic safety of the insurance in the first place.
Exactly. So some people might ask, well, why would I care about having all of this money in a health savings account? What would I do with that, right? Well, this can actually be an incredibly powerful tool for retirement or later in life. You can basically view it as a super awesome savings vehicle. So I like to refer to that as, SASV. Super awesome savings vehicle.
All right, more acronyms. That's what we need.
But the nice thing is once you retire, you can use this for Medicare or other health coverage if you're 65 or older. So how I said earlier, you couldn't pay premiums with these two accounts. You can pay, these are the exceptions I was saying for. You can use for premiums if it's long-term care insurance, if it's health continuation coverage, which is referred to as COBRA. So it's basically if you leave your job, they have to offer you COBRA, which is extending your whatever health insurance you had when you were an employee there. So you can use it to pay for COBRA. You can use it for long-term care insurance. You can use it for health coverage while under unemployment compensation. So if you're getting unemployment, you can pay for your premiums. And then, lastly, if you're over 65, you can use it for Medicare or other health coverage. So once you, get to a certain point, you can use this to pay premiums, which I bring that up because in America, at least, when I think about retirement, one of my biggest fears is figuring out how the hell I'm going to pay for health insurance.
Once you're not employed.
Yeah, exactly. So that's a very scary thing, so it's kind of nice to know that, this could be used someday for that.
So it sounded like of all those examples that you gave, so long-term health care, retirees that are over 65, people that have left their current job with the COBRA program, sounds like the majority of people benefiting from this are probably people nearing retirement, right?
Correct.
Because that kind of checks most of those boxes.
But mostly people in that 65 and older cohort, because I will say COBRA, a lot of times people who, like let's say you decide to leave your job when you're in your 40s or 50s. Let's say you retire a little bit early. We talk about that a lot on this podcast. You might elect to do COBRA, but it's probably going to be more expensive to do that forever. And I think sometimes there's periods of you can do COBRA for X amount of time. So it might not get you all the way there. So I say that because you're probably going to have to find a cheaper alternative and pay those premiums with some other source until you get to magic age 65.
All right. And then basically all the rest of your premiums are paid for as long as you've been putting into your HSA for, several years. And then you're good to go, right?
And compound interest, which tax-free. It's great because HSAs are triple tax benefit. They're tax-free when you put the money in, they're tax-free growth, and then it's tax-free if you use it to pay for a qualified medical expense.
That's a good question. So where is the money actually stored in an HSA? Is it a vehicle? Is it a mutual fund? Is it a stock?
My goodness, am I glad that you asked. So traditionally, people literally went to a bank and got a health savings account at a bank, and you just got whatever interest rate that bank gave you. So for most people, getting a plan, the insurance company would partner with a certain bank and they would say your deposits are going to go here and it's beneficial for you to choose this bank because we'll pay all the fees, so it'll be free for you, and then you'll get maybe 2% interest if you're lucky. Back when they were first set up, I know my first HSA I could have gotten all the way up to 4% interest if I had a certain balance, but I've seen those rates kind of come down and now hovering around the 2 to 3% if you're lucky. But the really exciting thing now is Fidelity, a couple months ago actually, or maybe even longer than that, announced that you could invest these HSA dollars. So HSAs are tied to you, they are your money, so you can transfer it to a different vehicle if you want to, the same way that you could roll over an IRA.
Right. So if you leave your employer, it goes with you.
Correct. Right? It's your money. And so, now you can actually invest this money in mutual funds and get a higher interest rate, which if you're, we're in our 30s here. And so thinking about the next 35 years until I'm that magic age 65 where I might, want to start using it, that, we always talk about the power of compound interest and how every 10 years you can double your money. So I'm talking about 3.5 doublers there, which is, pretty good.
Mm-hmm.
So, if you, let's say this year we put, the $7,000 in, well, then we're talking about 14 to 28 to 56. So I turned that $7,000 into $56,000 to pay for medical expenses in retirement. That's pretty sweet.
Yeah. So why would anybody choose to not use this, I guess?
So, well, I wanted to bring up one more point about retirement, and then I will get to that question, okay? The other thing I wanted to mention is when you turn that magic age 65, you can withdraw from your HSA penalty-free. So before then, if you take money out for a non-qualified medical expense, you have to pay all sorts of penalties and fees on that, right? But once you're 65, you can take that money out penalty-free. Now, you do have to pay taxes on it, but pop quiz, Brett, what vehicle does that sound like? So you have tax deferment from when you put the money in and on all the growth of that, but then you're taxed when you take it out.
Traditional IRA is what it sounds like.
Yes. Gosh, you are so smart. But that's it's a good point to make because you can also view this as another way to save for retirement,
mm-hmm.
which is really awesome, right? So now I will get to your question. If this is checking all these boxes and it's incredible and amazing, who is it not good for? If you have high medical expenses and you're blowing through your HSA every year or going further into debt, right? So if you get a high deductible plan and your deductible is $10,000 and you can only put in, $3,500 for a single person and an HSA, then the math isn't working out, right? Because you're not even able to cover your deductible every year, right?
Right.
So if you have a lot of medical expenses, this isn't the right savings vehicle for you. I think sometimes if you're a family and you have kids, your medical expenses might naturally be inflated for a while. So I think the primary people that can take a lot of advantage of this are people with either low medical expenses, and I don't mean like every single year over year, because I've mentioned before on the podcast, like I've had crazy things happen to me and I've had my, medical expenses spike. But on average, if you're coming in lower, then this is a good vehicle for you.
Right, because when bad things happen to you, it's in for several $1,000s, right? And easily, maybe once or twice even a year, and that's still a good vehicle for you, right?
Right. I've still been coming out ahead with it. It's still a good vehicle for me. I'm pretty young, I'm healthy, and I say that as it's my medical expenses are a couple grand a year, and well, mine and Brett's collectively, because he's just like a tank, and so he compensates for my freak of nature accidents. But, we can contribute up to $7,000, right? So if you look at that equation, obviously we're coming out $5,000 ahead with that simple math example if we're able to max this out. But I know some people that, just their prescriptions alone would cost them $1,000 a month if they weren't on a better health insurance plan. I know people who get allergy shots, those can be really expensive, right? So if you're getting anything like that and you're on a, lower deductible plan for those reasons, it might make sense for you to stay over there and, just focus on maxing out a traditional IRA instead. But if you can do both, obviously do both, right? Max out everything.
Right, exactly.
So, all right. Well, do you have any other questions about this? I feel like I'm missing things, but I got through most of my notes, so.
I think we covered why you would use it versus why you wouldn't. We covered what it is versus an FSA, right? I think one point to clarify, I think we talked about earlier, we were talking about high deductible plans that are provided, right? The insurance plan from your provider, and there's a difference between that and the HSA is a benefit of that plan, right? I think we switched, we got right into that. So, this is just a tool that you can use that is given to you as part of having that plan. I don't know of any plans anywhere where it is offered outside of a high deductible plan.
It's not. You can't have one if it's not. It has
Industry rules dictate?
Correct. You can only have a health savings account if you have a high deductible plan.
All right, so somebody that thinks they're important somewhere made that rule. Yeah.
Well, it's it's really to encourage people to switch to high deductible plans. And this is for a whole host of benefits of like health insurance costs actually come down when people are aware of how much things cost, and you're more likely to, shop around. Because if there's two doctors that are equally as good, but one is charging $100 for an office visit and the other one's charging $200, once those prices are put in front of you, which one are you going to go to?
Yeah, I like the high deductible plan model also because it gives you more choice. Like when you're in like one of the PPO models, you have to be really in network. Otherwise, you pay a ton, right? Yeah, most everything's covered if you're in network. If you're out of network, you see the expenses, right? With a high deductible, you kind of see those expenses a little bit more anyway. And so you just have more choice. Like if you want to go out of network, it's not hurting you that bad.
Well, yes and no, because preventative care is all still 100% covered, even under a high deductible plan. So if you're going in for your annual physical, it's good to make sure your general practice doctor is part of your network, right?
Mm-hmm.
Where we've kind of strayed from that is dermatology, which isn't covered on a high deductible plan at all, and dentistry, right? Because that's its own thing that's separate. However, you can use your your health savings account to pay for dental expenses.
Okay, that's nice.
So it's kind of confusing because I think people think of all of that as the same thing, but there's actually medical, dental, and vision when you're signing up for a health insurance plan. But your health savings account can be used to pay for any of those expenses. So it's a little bit tricky, but it does cover those. And another thing I wanted to point out is, as I mentioned, the qualified medical expenses, the definitions between HSAs and FSAs can vary, and they are updated annually. So you can hop on, the government's website. You can just Google like HSA qualified expenses or FSA qualified expenses and pull up a list to see if what you're, researching or looking up is covered by this.
Right. So if you want to see if massages are covered under that, take a look.
Yeah.
Hey, a lot of times it is. Don't give me that look. That and chiropractic and all kinds of like interesting things probably are part of the list.
Well, I think those are more usually part of like your health insurance, not as, I don't think they're covered by
anyway,
HSA.
People love massages. Take a look, see if it's out there. I didn't look in advance, so.
Get a prescription from your doctor, then you have a higher chance of it being covered.
Oh, speaking of which, prescriptions is the other thing. I think we've mentioned before, but shopping around for prescriptions is also something, since we're talking about medical expenses, definitely look into that. Look at the different suppliers, like whether it's Walgreens or CVS or a local pharmacy or apothecary shop sometimes, right? They all have wildly different prices for the exact same prescriptions. So the next time you go to a doctor and they're like, where do you want us to send this prescription to? Just take it with you and then look it up, and also look up if there's any like coupons for that prescription that you can take to any of these vendors. And I think it's built into Google that like has a little calculator or pricing sheet that will help out with that.
And I mentioned it on one of our 10 Ways to Save $50 episodes, but goodrx.com is another website that you can just type in your prescription and then it'll show you the prices and it'll give you a coupon and show you the price when the coupon is applied at different pharmacies. Right, you put in your zip code and then it pulls up a map. So we've used that very successfully. I mean, it got a prescription down from like $80 to $17 for me, and I was picking up 2 prescriptions, so I just saved $120 there, which
for nothing
is awesome, right?
For 2 minutes of a search, right?
Yeah.
You didn't even have to sign up for anything, right?
Exactly. So, penny saved is a penny earned. Am I right?
Mm-hmm.
All right. Well, I think we covered everything pretty well here. If you still have more questions about HSAs or FSAs, feel free to reach out and let me know. I'd be happy to try to help answer any questions that you do have. And furthermore, if you are, I actually love hearing stories of people. Like, I was so excited that a listener reached out and was like, hey, I'm using this as a really great savings vehicle, and you should talk more about it because it's a really cool thing. Or super awesome savings vehicle, sorry. And so if you are using this, or if you're using something else that we don't really talk about much, something that we might cover in the future is kind of talking about the Roth conversion ladder, because that's a really cool trick people can do to, if you're going to retire early, to make sure you can fund your retirement at those younger years. So we can talk about tricks like that if people are interested. I guess just let me know what you want to hear, and we will cater our podcast to our listeners.
Cool. All right. Thanks, guys.
Thanks. Hey guys, thanks for tuning in to this week's episode of Money in the Bank. Make sure to subscribe to us on the iTunes or Stitcher app so that you get weekly alerts every time we post a podcast. Or if you want, you can visit my website, moneyinthebankpodcast.com. And if you want to reach out with any questions or further comments, please email me at Angie@moneyinthebankpodcast.com. I look forward to hearing from you.
Money in the bank.